Excuse me, sir. Sorry for the disturbing.
Yes, yes.
Sir, we can start now because we already have waited 5 minutes, sir.
Right. We'll start.
Okay, sir. Okay, thank you.
Yes. Good evening to all of you, and this is the second day. Hello.
Sir, good evening.
Good evening, sir.
Right. Today, actually, this is something like marketing session, basically. So, but there are sums at the end. You might have seen this very simple sum. Right. So this is the answer of growth matrix. So there are 4 quadrants. So if you need to see more details, you can search Google and get more detail. But I am here to give a brief explanation. So you can see on the top existing product and right side the new products. Even left side you can see existing markets and new markets. So you don't need to memorize. So if you see the matrix, first quadrant is on the top existing products. So left existing products. So if you are putting the existing products into existing markets, that is called market penetration. So these are marketing jargons. So you are basically delivering your existing product to the existing markets. You can do whatever marketing program, 5P, 4P, anything. But this is, again, you can see right side of your figure, increasing risk. So if you are moving from existing product to new product, the high risk. So below the figure, you can see increasing risk to right, left to right. So it means diversification is the most risk business. So what is right side of the second quadrant is product development. So you see the top new products into the existing market. So you will deliver the new products to existing market. And one below the market penetration is the market development. So the market development mean you are going to put the existing products into new markets. For example, now Siddhalepa was doing well in Sri Lanka. Now we have moved to India. So that is existing product move into the new markets. Another example, Damro. Damro is a furniture conglomerate. Now they have moved to India, and there is factory in India and Australia. So that is market development. That you have to understand what is the market, and they may be doing a lot of market research before moving into, because this is you can see it is high risk, increasing risk, even market development. So product development, as I told you, new product into existing markets, and diversification mean new product into new markets. So you can keep in mind these 4 quadrants, very easy. So if you see existing product into existing market, that is market penetration. So it means you are penetrating the existing market and try to make the profit. Product development also a little bit risky because risk has increased because you are doing new products. New product may fail. So that is a high risk. Even this is a Munchie biscuit company. They are sending products to all over the world, around 35 countries. But they introduce cheese biscuits, but people expect a lot of cheese in that biscuits, but because they show a big hill coming as a cheese, like a glacier. So the people expect full of cheese, but it failed. Even if you take Coca-Cola, so they were trying to change the formula because when they do the research, people ask to change the recipe. But when it come to the real market, people don't like to change the existing recipe. So therefore, so the existing taste. So they have invested billions on new products, but fail. So therefore, that's why it is risky business to do. So therefore, you have to be very careful when you are moving to new products in even existing markets. Product may fail. So then you need to analyze. I think as a managers, you will work with the marketing, finance, operation, production. So then you should have understanding about the marketing concept because they are taking the risk. Even being a finance guy, I don't take any risk because they will introduce new products and they will get the blame also if the product fails. So that's why it is little bit risky than the market penetration. I think low risk strategy is the market penetration. No harm because you are having existing product, you are just moving to outside. But if you take diversification, also very high risk. Why? New products to new market. We don't know how it works in the new markets. Therefore, please go through this detail, each and every strategy, the growth matrix. Growth means we are going to move to up and we are trying to increase the wealth of the company. So it means naturally it is profitability should be very high. So then you can create a lot of reserves and you can increase the wealth. So our duty is to make sure the company wealth is increasing continuously. Because you need a lot of money to invest in new product, new markets. So therefore you need more money. So you should have a profit in the existing market. So I think Damro and Munchie in Sri Lanka, they have already covered the market in Sri Lanka and they have strong market in Sri Lanka, at least in order to cover their overhead expenditure, and then they can think about exporting. So I will move on to the next. So what are the available growth studies? So the small explanation. You can read. Increasing sales of existing product in current markets. What I said you. Second one, entering new market with existing products. So detail you can obtain from the web. So only thing in the exam, sometime I will ask what are the growth strategies available and Ansop matrix. So then you can explain. This is a homework. So these 4 strategies, all growth strategies. That is with your existing product and going to new market and going with the new product, all related to the product and markets. But there are other growth strategies also. This term may be very not familiar for you all. So in the business field, it is well established concept. So acquisition mean buying other companies to expand capabilities or markets. Yeah. Whatever things, even if you want to introduce new product by your company, you can acquire another company. Acquire mean you are buying the company, not a merger. Or we will discuss in the end. We have a lot of strategies, but for the time being, acquisition mean buying other companies to expand capabilities or market share. So you know a lot of examples are there. We will discuss. Acquisition mean one company is buying another company. The second company is absorbed into the first company. So there are strategic partnership, collaborating with other businesses for mutual benefits. Vertical integration, horizontal integration, everything you can see and get the details. If you type vertical integration, they will give even chat GPT, whatever place you can find. So these are the strategies in order to go for higher growth. It means you are trying to increase your wealth of the company. So you can see acquisition, strategic partnership. We'll discuss these things in the latter part of this session, and we'll get more knowledge. I have put example also. So digital transformation, leveraging technology to improve efficiency and reach. So you know a lot of, even in Sri Lanka, I don't know other countries, the banking system was very conventional at the beginning, but now all the banks are moving into high technology. So otherwise you will lose the business. I think all over the world it is the trend, because you know the generation change also, X, Y, Z. You read this one. Now latest generation is the alpha generation. So they born with mobiles. So therefore they will use technology. Even in China, I have seen whatever they own, they order using the web page, online ordering. Even shirt and trouser. I don't know, but they ordered via online. So therefore, the digital transformation is essential. Even now, you all know the Sri Lankan government also moving to digital transformation, because that will help to increase the GDP. So even same story to the company. We can create global market via online. But Damro and the singer Damro, they introduced online buying in Sri Lanka, invested millions of rupees, but it failed. Why? I mean, society is not conducive to the digital transformation, because we are far behind if you compare to Singapore, China, or India even. So you can increase the technology and deliver your good to the customer. So you know how the Alibaba.com and Amazon.com, how they are selling all over the world. Now I think in Sri Lanka there's a problem because now they are going to tax you. So then the prices will be up. So that is the one thing. Another thing is coming because free date that I don't know if they are correct or wrong, but now people were benefited earlier. Now they are moving away. So anyway, the digital transformation for the company or your organization, that will help you to even reduce. I have visited the National University of Singapore, and they drastically cut their HR. I think they have reduced almost 75, 100%, around 20, 75% reduced staff by introduction technology. So the manual, even you can propose to your company, even procurement system using technology. Otherwise, you are wasting time on papers and evaluation. So it is very difficult, cumbersome task. So digital transformation is the need of the hour. Why? Generation change. Now I think most of you may be X or I'm generation X. Yeah, why is that? You know the Z people now what they have done in other two countries, Nepal and Bangladesh. Because what happened in Nepal, I think they stopped the Facebook. That was the strategy. So that went up to collapse the whole country. I don't know, but I feel, I don't know, maybe other reasons also, but in the face of it, it is, I think, prohibition of Facebook. Even Sri Lanka stopped, prohibit the Facebook for a shorter period, I remember. But again, lift the ban. So therefore, this generation required, alpha generation, they are recently born, now they are around 12 to 15 age. So they are moving very fast with the digital. So therefore, if you want to make sure that new customers, so you need to change your business in order to grow. Now, next one is the customer retention and loyalty program. Now any business, the two things are there, even for the university. We have existing students. So you need to serve the existing student and we have to try for new student. So our business mainly focus on capitalizing on existing student. And for example, now those who are doing undergraduate program with our university, we have a 78 program. So we promote them our master program. So it means it is a new product to the existing market. So because we need to retain the customers, because otherwise we will lose our income. Even move into further business, especially the Open University of Sri Lanka. Now we are trying to develop the concept. Open University is for your family. Even grandma can come and your mother and father can come. We'll have a separate program. So all the money expended by the family for the education is coming to Open University. So that type of a concept actually we are discussing. Even I have been to many open universities in the world. So in Thailand, they do that. They have intake of 600,000 per year because they have accommodate whatever the amount equal to the bond newborns. So newborns 600,000, they are taking the university. And they promote different program to different, because we don't have a age limit or something like that, like conventional universities, open university. We are offering our program from age 16 to 80 or whatever age, if the people wish to come and learn. So in other countries, I have seen cooking class. So then the mother and father coming with children and children studying separately, and mother and children participating for these programs. So like that. I mean, now retention of customer and the new customer, capitalizing on new customers is the most essential thing anywhere in the world. Even your businesses, you need to retain your customers, and so therefore you can introduce loyalty program. Now many companies, they are, especially food chain company like Food City, John Hills, Cargills. So they are all in Sri Lanka giving this loyalty card. So even pharmacies, I think this is maybe common to any other country. Even it is common because you need to keep the existing customer. So again, I have given the little bit detailed market penetration. You can read. So maintain or increase its share of current market with current products. So if you are dominating in a market, you can secure, because you may be the pioneer in that market. You have gone first, so therefore you have a already capitalized market. So because it is very difficult to come to the existing market for a newcomer, because you have to invest huge amount of money, because other companies already set up. But it is not a big issue, because new companies are moving, even like IBM collapse. But small company, they came up, Microsoft. So these are happening in the markets. Even giants fail, small companies prosper, like Apple. They have, you can read all this history of the companies and understand. So this is I said it is a low risk strategy. Why? I have put in red. What is capex? Can anybody tell me what is capex?
Capital expenditure.
Thank you very much. I purposely put that, because these jargons you have to know. All the people, students in this program, whatever the position you are in, these are business word, capex, opex. Other one is the opex, operational expenditure. So this is low risk strategy, mean no capex. You don't need capital expenditure. Why? You are again moving only the existing product into existing market or new market. So you don't want to spend on R&D and product development. You don't need to do anything. So whatever your existing product, but you know there is a life cycle for everything. Even our life, we have a life cycle. Now we are on the verge of leaving the world. So likewise, even product is same. So that's why they are changing the name. So you can learn those things. So anyway, this is a low strategy. If I ask in the exam, can you propose low risk strategy to grow your company? So then definitely you have to explain that is market penetration, no capex, therefore low risk. Because these proposals are coming to the board. So you may be the one of the member in the board. So then if the marketing people come with the market penetration or whatever the diversification, so we have to consider pros and cons. Otherwise, you are incurring huge amount of money. I told you the Coca-Cola is a well-reputed company, but again, say they have done the mistake. Munchie in Sri Lanka is a big company. Again, they fail. Now they have removed that product. So basically, what I expect you, what is it, and what is the risk, and what is the most appropriate strategy for your company. If you are a new company, definitely you have to try for new markets. But if you are an existing conglomerate, big company, conglomerate means many companies into one group, one umbrella. So then they will have a different strategy. So based on the company you are in, so you need to see what is the most appropriate growth strategy for your company. So market development, we are moving to new geographical areas. I explained you, we have moved to India. The Siddha is a famous company in Sri Lanka. Right. Again, now earlier, good old days, we didn't have a sachet, small size packet. But now you see Sunsilic, whatever things, even Nescafe, you find in small sachet. So small pack. This is also you are increasing your product because anybody can buy. Even toothpaste. I have seen very tiny tubes are there because you use for 2 days, so 3 days visit. So you have a pack like that. So small pack, different size, different pack size. So that will increase your business, increase your sales. The new distribution channels, the example is organic foods in supermarket. Now differential pricing policies. You can see travel companies develop cheap long stay winter breaks in warm countries. Low risk. So what are you expecting is the increase in the number of customers, number of sales. Otherwise, company will die. So you need to increase your revenue. Revenue means the number of product into price. So this market development again little bit low risk. This product development, it is riskier. So I have mentioned in black the last line, riskier than previous options. So as I explained you, the company can exploit its existing marketing arrangement, such as promotional method, distribution channel at low cost, because you know your customers, good knowledge, customer wants and habits. The cost of the entry to the market will go up and riskier than the previous. Previous to it is little bit riskier because you are developing new products. I gave you 2 examples. Failures happened in the world. So this little bit riskier than previous. So diversification is new product into new markets. Now there are four under the diversification, related diversification, unrelated diversification, horizontal diversification, vertical diversification. So each and every strategies under diversification there are 4. So you can, when you are answering the my questions, so if I ask what are the diversification strategies available to company, so then you have to explain. So you can get more details. Related diversification mean entering new related business. Entering related business. For example, hotel company in China acquiring hotel company in Sri Lanka. So they are doing the same business, entering into related industry. Unrelated diversification, entering into complete new industries, not related. So just word says what it is. Unrelated, related. Related mean you have existing healthcare products, so you are buying hospitals, expanding. So this same related business. Unrelated business, new business. Now, buying and selling company invest in hotel industry. So in the recent past, we have seen a lot of investment in hotels in Sri Lanka, because we expect our tourism to grow day and day. So therefore, accommodation facilities to be given. So they have built many big hotels. So horizontal diversification means new product for existing customers. So vertical diversification, this is little bit new. For example, if you take food cities, the retail trading market, now they are moving back to farmers. So even food city in Sri Lanka, Kargils, they are buying from farmers directly. So therefore, they are moving down the supply chain, right? All their products now, they are going to Norelia and all these Matale in Sri Lanka. So they are purchasing from the suppliers. Supply, I mean your farmers. Again, moving up also. So they are acquiring retail business. And they are expanding new business, new places. So if you take this retail industry, they have a very small margin. In order to get higher profit, what you have to do? You have to increase your sales. So because there's a very thin margin, so they capitalize on number of quantities sold. So therefore they need business. So therefore what they are doing? They are expanding number of outlets. I don't know, you go everywhere, you can find the Cargill's Food City Place or Keels, John Keels. Even other countries I have seen 7 to 7, 7 to 9, 7 to 11. So there's a retail, the delivery companies, they have set up the outlet all over the world. So read more and more just to explain and just to understand what it is from your point of view. And I'm giving only very small explanation. So now we have mentioned all these horizontal diversification, concentric diversification, vertical diversification, conglomerate diversification. I have told you many times, conglomerate mean insurance company, whatever the company you say, and they are in one umbrella. We have a lot of John Keys conglomerate. They have bank even. So one group company having so many subsidiaries doing different business. So that is called conglomerate diversification. So they are into industry, insurance, tourism, hospital, different type of business, but they are under one umbrella. That is called conglomerate diversification. So what do you think? This is conglomerate diversification is high risk or low risk? Can
Low
anybody?
risks.
Low risk.
Yeah, because why? If the tourism come down,
They have the other means to earn.
other means, so that's why. So therefore, they are reducing their risk by moving to different industries. So therefore, even if you are in one company, so you need to. There's a story: ice cream seller and the umbrella.
No, I have a question.
Yeah.
Don't you think that they are depriving others chances to get into the industries?
Yeah, what is business is killing the competitor. So I agree with you, but what to do? You are doing business, killing your competitor.
Socially and ethically, there will be. I mean, in the long run, there will be a problem.
Yeah, but you see, I agree with you, but again, this conglomerate, they are spending huge money on social care, ESR program, CSR. So that way they are touching the customers. So anyway, new companies can come up even though you have a big conglomerate.
Can come up, but they can't sustain.
Yeah, they are fighting because I told you, business mean you are killing your competitor. Even though ethical business, but from their point of view, the conglomerate mean that their owners having low risk because they are moving to any businesses what you want. So they are reducing the risk. This is business. Right. Related diversification is development beyond current products and market. So I have explained you JS and W. Horizontal organ integration make sure. Actually, as you said, if you take retail industry, now they are moving backward and forward. So all the people in the chain is getting trouble because they are extracting all the value chain. So they are moving to, actually we don't do that. So as a university, we teach undergraduate and the postgraduate. So as you said, we can move into the A-level class also. Because why? We are going back. So we don't do that because otherwise that business will collapse. So as you said, we want to live a very harmony way. So, but in the business, even doing marketing campaign in order to, price cutthroat price cutting, and so you have a strategies to destroy your newcomers also. That happened. Even though it is unethical, whatever, but they do that. So we have done. I remember good old days. Bristol company was selling at that time. I remember 1 rupee or 150 for cigarette. But three rows company, three rows. There's another company called Three Rows. That was around 80 cents or something. Now Bristol has reduced to 50. So then what happened to the Three Rows? Disappeared. So something like that, Ajay. So example. So they want to grab the business. So they are killing, not shooting, but other way around. They are doing this. Anyway, you can propose. non-ethical business. So vertical integration. So now this is Sri Lankan example, backward integration, acquiring suppliers, Milko acquiring farms, Food City acquiring farmers. So that was something like that. The backward and forward integration in the same line, same value chain. So you go back or go forward. If you are a production company, so you acquire distributor also and retailer also. Then all the people in the supply chain in one basket. So they can capitalize on their profits. Advantage, vertical integration, a secure supply of component or material, hence lower supply bargaining power. So you see, now, if you can catch or if you can acquire suppliers, so you can have the bargaining power, low supply having a lower bargaining power. Because why? Now, even in businesses, we don't depend on one customer for the whole supply. That is depend on the one customer, one supplier. So we have to reduce risk by moving to 2-3 suppliers. Then if one says I want to increase, so we can tell, okay, keep your product, I will move to the another supplier. So this is what is happening. More effective pursuit of differentiation, creation of barriers to entry. So disadvantage, over concentration. It means you have to, now earlier you were doing only selling products. Now you are moving to the farmers. So you have to collect all the products from the farmers, from their field, and bring it to your stores and sell. So if something goes wrong, for example, I remember, we all remember COVID pandemic. So Food City chain affected most, I think, because movement is not allowed. So farmers are not allowed to go, but you have to maintain all the places. Then they try to do it online. So many problems. So more eggs in the same market, end market means. So you have a high risk.
Sir, ongoing issue is there right now in John Keels.
Really?
Keels have started importing compressors for their ACs.
Right.
Instead of purchasing it from suppliers, I mean the service providers. So what happened now? Although they imported, they do not have the ability to fix them, install them.
Yeah.
So they imported and asked same service providers to come and install. They have refused.
So
Now
that
all the service providers get together and now they are refusing. Now they are in trouble.
yeah. So you see thank you very much for sharing your real life experience. So this is happening. That's what I am telling. So anything before you move into the decisions, so you have to evaluate very well. And now I think if you take compressors or whatever thing, I like to purchase from a reputed company and I like to see installed by them, because I will not give to the electrician to come and install. They will come and install. But later, if you want get it repaired or get it serviced, that will have a big issues on me. So therefore, actually, they need to do their, but maybe HR cost also very high for the installation and other things. We'll see. So unrelated also, moving to the diversification strategy. Right. So companies having so there is two ways businesses can expand. One thing is the organic growth, right? Key growth methods. Organic growth mean you are expanding using your revenue. So whatever you have money in your hand, it means the existing reserves in your company, and investing on new product or whatever new market, that is called organic growth. So you don't like you investing using existing money, existing profit. So you say it is internal resources and efforts. So increasing sales, opening new location, developing new product, all funded by your own organization. That is called organic growth. So next one is a inorganic growth. So there you find mergers, acquisition, joint venture. I have more slide in the end explaining mergers, acquisitions, and joint ventures. So these are a business word again. Mergers mean like a marriage. Two people get together and living together. So merge mean something, a lot of mergers. In Sri Lanka, you can find in the world also, Maruti Suzuki, the two mobile giants, they get together and develop these mergers. Acquisition, I have told you, you are buying company. Joint ventures, again, independent entities getting together to do the business. That is called joint ventures. So I have a lot of examples in the time to come, I will discuss. So next one is the horizontal growth, vertical growth, organic growth. These are the growth strategies. Anyway, any company in the world, they need to grow because they are expanding, they are a number of employees are expanding. So you need to cater them. Therefore, you need the growth in order to invest. Even to sustain, you need money. Sustain the business. I know those who are doing business may experience all these things in their life. So diversification, product expansion, again. I have explained market development, strategic partnership, alliance, franchise or alliance. Licensing, something like what is given by allowing other to use. You can go anywhere in the world, you can find KFC. So therefore, what they are doing, they are giving the their secret to share at a or else even these food companies, they are importing everything from the mother company and just paying royalty for the licensing. So they are doing the business using their brand name, everything. McDonald's. So example for franchise, for licensing. So they get royalty, these companies. Digital transformation, leverage and technology to drive growth and efficiency. I explain IT side, e-commerce, data analytics, AI integration. Now the latest word is the artificial intelligence. Everywhere they are talking artificial intelligence. So it is help you also to write report whatever you want. AI. But make sure to read A to Z. You can get whatever you want from web, but make sure to read each and every line because there may be mistakes. So you can add your thinking to that whatever report. But basically, it's okay to get some idea. You can refer to these AI generated reports or whatever you want through from Cloudy or ChatGPT or but you can use, you can see. Even whenever I want to write something, I am looking at that. Even I want to know about the debt sustainability in Sri Lanka. So just I type the what is the debt sustainability in Sri Lanka. So they are giving all the things. So you have to verify only. The last one, number 12, customer focus growth, increasing revenue from existing customer, upselling, cross-selling, loyalty program. I will not ask any question related to the for your marketing, but at least you should know what is this word for you to meaning upselling, cross-selling, loyalty programs. So
Sir, excuse me.
yeah.
Is there a difference between merging and what is called joint venture?
Yes, yes. Joint
What
venture.
is the difference?
Yeah, merging mean you get together and like a marriage. You after that only one, but even two companies getting together and making like Hewlett Packard and I told you Maruti Suzuki. They got together and create this company. So that is merger. But when you come to joint venture, so even the two independent party can do the business for a maybe 5-year period in a joint venture. For example, you have a huge project to be completed in Sri Lanka, like Mattala Airport. So two companies can get together and do the project. That is called joint ventures. It's okay.
That means a joint venture forms for that project only.
Yeah, yes, it's
Okay.
yeah, right.
Okay.
Okay, right. Now business valuation, little bit different subject for you all, but don't worry. Again, the net present value is coming. So, but you have to understand this concept. I don't want you to do a very technical sums. Never ask. So, but try to understand. So, business valuation is because these are the subject according to your syllabus. It is we need to teach you. So we talk about the businesses up to now. Now we are moving to valuation, business valuation. As simple. Can you tell me what is your value? Your value. Each and everyone has a value. Basically, what is your assets minus your liability? Even personal valuation you can do. I can do, I will check what are the assets available to me, editing everything, and deduct whatever the liabilities. I have bank, people's bank loan, the bank loan, university loan. So reduce everything. Very simple valuation. Valuation of your life. So you can value yourself also. How much worth you for your family. So for me, if somebody wants to value, they can check my cash flows now up to 60 years of age and get the present value. That is my value. So same way we have to calculate the value of the business as well. So it is not a difficult task. So we have a simple methods to value the business, and we will learn business valuation. So you can see when you do the sums, it is not a big deal. So what is the purpose? Buying or selling a business, mergers and acquisition, litigation, example, divorce settlement, partner dispute, state planning, securing finance or investment. So now I explain you mergers and acquisition. So, but there are divestment also. It means you are selling your part of business because which is not strategically important to you. So you don't have a technical experience or technical know-how to run that business. So as of today, so what is my business value, my value, economic value? We have a lot of way to calculate. So now business valuation means you want to value your business. How much worth? So same way, the individual can value their business or value their life or whatever. So just they need to understand what is the assets and liabilities. The difference we can take as our value. So first one is the income approach. If anybody is having this valuation technique, just raise the question. So now value a business based on the present value of expected future earnings or cash flows. So I have worked with you all the last session, how to value the cash flows using net present value. And I reminded all of you to learn present value because it is everywhere. If you take business valuation, present value comes. So therefore, at least you need to know this concept, not like other IRR, ARR, IRR, MIRR. I don't ask anything. But present value is very important in your life also. You can see your cash flows in the next 5 years and plan how much you can save, how much you can spend, how much you can invest. So your cash flows are easy to calculate. Your salary may be 10% increase in the every year. So you can get the cash flows and see the present value. So income approach means discounted cash flow. There are two things: capitalization of earning. Income approach means you consider what is the income generated by your organization, your business. That's why we call income approach. We consider only the income or cash flows. Future earning means cash flows. So there are two methods on the income approach. First one is the discounted cash flow. So you get the future cash flows and use the discounting factor and get the value. Very simple. We'll see when we do sums. So the second one is the capitalization of earning. So if it is your earning is 500,000 per year, so just 500,000 divided by your capitalization rate, it means the rate you earn so far. Assume you are getting the profit percentage of 20%. So if you divided at 150,000 by 0.2. So we'll example 500,000 divided by 0.2. It means your business value is 2.5 million. Just divide it and see. 500,000 divided by 0.2. 0.2 mean your capitalization rate mean what is simply your borrowing rate or your return on income. For example, if it is a bank, it is a return on income is around now 10%. So use the if you divided 500,000 by 0.1, so that is the value. 500,000 is the cash flow divided by 0.1, 5 million. So that is the way you value your business. Yeah, capitalization of earnings. Right. We will do the sum, don't worry about that. So we'll do the each and every approach I have the sum. Second one is the market approach. So we are talking about the valuation of business. First one is income approach. Second one is market approach. Now, actually this market mean now under comparable company analysis, CCA use valuation multiple like PEO, EV, EBITDA. So now if you, I don't know whether you are having a knowledge in share market. So I will explain you. Now, what is happening in the share market basically? Anybody can help me? Mandula.
Investment.
Yeah, investment. Okay, what type of investment? You are investing where? And what they do basically? Share market, I am talking.
We are investing on buying shares of companies.
Okay, fine. Thank you very much for both. Now you are, you are aware of that. So now you are buying shares of a company. Okay, it may be 10 rupees, it may be 100 rupees, it may be 1,000 rupees. Now those shares are publicly sold. That is share market. Now, if you, for example, if you take one company share market price is 100 rupees per share. You have invested 100 rupees at the beginning of the year. You have buy 100,000 shares paying 100 rupees. So at the end, if the share price is 150 in the market, but your company share is only values 100 rupees. You are getting bonus whatever to the value of 100 rupees. But in the market, your market price is for share maybe 150 rupees. If you then you can sell to another party and get a capital gain of 50 rupees per share into 100,000. That is the return you are getting because of this market value. So when it comes to businesses also, we use that market value for our calculation. So that is called PE, price earning ratio. So if the market value is 100, earning per share is 10 rupees, you are getting 10, the PE of 10. So we'll have explain, I will explain, but for the time being, why this is market approach mean you are getting price of the market. That market means share market. So what is the value of your company share in the market? So we can invest, we can get capital gain, we can get the dividend also. So we will forget everything, but just you should know what is share market and what is happening there. So actually, what is happening there is selling the company shares. Each and every company selling their shares in the market. People are buying, people are selling. So buying and selling. So then depending on the demand and supply, the prices will decide. Now we have a good share market now. We are having highest recorded value for shares. There are two indices. So both are in a good trends. So that means the shares are buying and selling at a high level. That's why prices are going up and everything. So that is what basically happening in the share market. So what for you should understand what is the market value of the share. Share, you can see, even if you take the newspaper, even if you move to the any share market in the world, you can buy. You can see John Keys is 50 rupees. Other company, Browns and company 10 rupees. Some company I have seen 1,000 rupees, but their share value is 10 rupees. But market has gone up to 1,000 rupees, 900 rupees. So then if you want to sell your company, you will see what is the price in the market. But in you purchase 10 rupees, but now it is 100. So the company valuation people, they will use the market value. So that is called multiple like PE into EBITDA mean earning before interest, tax and depreciation, amortization. So this is a technical jargon, accountancy jargon. Simply say, you can see profit before tax. So you have to deduct tax, profit after tax. So profit before tax, you can take as one item to value your company. So we'll see in the sums. So precedent transaction. So you can see now you are having an insurance company and another insurance company coming and ask, hey, would you like to sell your company to me? So then how do you decide the value of the company? So there are a number of shares into, you will say, I will sell at market price. The last time it was sold, insurance company share was traded at 150 rupees. So give me 150 rupees into I have 1 million shares, 150 million. So similar thing like now, if you want to sell your land, what is the method you are adopting? So tell me, you have a 20% land in Colombo. So you want to sell. What is the
You check the market value first.
How do you check?
You can inquire from the same area and find out how much of the cost of a purge from that area and how it goes. I mean, practically what you can do.
Yes, exactly. That's what I want. Business valuation. Now, this is the same thing. So you go and see your land is there. You ask neighbors. Now the neighbors can tell, now we are selling at 700 rupees. Okay, how can you make sure? So then they will tell the adjoining land sold by that person at a purchase value of 1 million or 3 million or 5 million. So that is the value you are taking. So if somebody comes and asks you, can you sell, can you give me your land? Okay, that is the way we value. So precedent transaction mean the previous transactions. That is the way we sell our companies even. So somebody, right. Okay, thank you. So therefore market approach mean again you look at the market and we will do a calculation. Don't worry about that. So have the understanding about the share market, the way you value your land, same thing. Valuation is not a big deal. So if you want to sell your land, you will go and check. You will ask neighbors, what is the land value here, and then they will tell. Other man came and purchased at this price. It is close to the road. If you are far away from the road, this much is the value. So that is, we can set our values based on their value. Number 3, asset-based approach. So values the business based on the value of its assets minus liability. I told you at the beginning, what is value of you? Value belongs to you. What is the value of you mean? So your assets minus your liability. So this asset-based approach. Now, if your company like a IT company, you don't have big assets, isn't it? I mean, you are doing million of business, or you are creating software for other company, so you don't have land. But some companies, they are having huge land, like Milko, they are having acres in Colombo, even Narayana, their big land is there, worth billions. So then if you are want to buy Milko, then you will get all these assets into your pocket. So then we should not value these land, these companies using any other techniques. Share market value may be very low than the real price. For example, during the COVID season, I think, as I remember, Ceylon Bank, all these companies went down huge market loss. For example, the 100 rupees share was sold at 7 rupees. So, like increasing, there's a decreasing also. So, now if you value that type of a company having a huge assets base, so you should not use the market base or something, and you should go for asset base, or you should go for asset base and also market base and income base and compare 3 values. That is the way you have to do. So this is purely a term of valuation or accounting background, but you can understand. So values the business based on the value of its assets minus liability. So you can simply work out your value. So take your all the assets into consideration and put that value. Asset mean your land, your house, your vehicles, your businesses, whatever. Assets hand in hand, and just minus your liability. How much you are liable to pay to others. So then you will come up with this value of assets value, or that is the value of you. The next one is under the asset-based approach, book value method mean you can read the balance sheet of the company. Even balance sheet mean, now we call it statement of assets and liabilities. Again, same thing. Book value method mean if it is a company, if it is a sole proprietorship, they will maintain the set of accounts. In there, even you don't need to know accounting. So you can go through the balance sheet always, both side tally, liability. One side is assets, other side is liability. So from the book value method also, what you are doing, getting the assets value, all the assets value, and minus whatever liabilities. Then you will end up with the value of the company. Second method, adjusted net asset method. Net asset means same thing. Net asset means assets minus liability. What is remaining is the net assets. So we will do more sums having after the break. Otherwise, so. So this is income approach, discounted cash flow method. So now you are very familiar with this type of a calculation we have done. So you can see you expect a business to generate following free cash flows mean just think about the cash flows. Cash flows belongs to you. Free mean you can use these cash flows freely. It means how much is giving by your company for next 3 years. Now what we are trying to do is here using the income approach, discounted cash flow method, we are trying to decide what is the value of our company. So can you all work out this sum? So I have given, only thing you have to check and tell me whether these figures are correct. I think you got the slide earlier. So we'll have a short break. I will come after 15 minutes. So during that time, take your calculators and check what I have written here is correct or wrong. Make sure. Now we have done this one. So this is a simple example. Even grade 5 children can do this. It is only multiple and subtracting or this whatever the thing. So this is the business. You have free cash flows for next 3 years. Assume now after 3 years we don't have anything. No, there's another one. After year 3, you expect the business to grow at 3% per year forever. Your discount rate is 10%. So I will explain after the break, but go through this. Anybody can check, everybody should check the figures and tell me whether it is correct. Now before you can see the formulas also given, I will explain you. But here up to year 1, 2, 3, it is a simple. Cash flow year 1, 100,000, you discount by discounting rate. You know how to get the discount rate. You divided 1 divided by 1.1, 1 plus R. So check all the figures whether all are correct, and please work out and if you have any question, let me know. Okay? Give me 10-15 minutes. Right. Shall we start?
Yes, sir.
Okay, thank you. Now, in year one, our cash flow is 100,000. If you divide 100,000 by 1.1 to the power 1, so you will get it 90,000. Can you get calculate and see? 1 divided by 1 point to the 1 plus r mean 1.1 to the power 1 mean 0.0990. Did you all get the values?
Yes, sir. These values are correct.
Right, thank you. Now, up to 3 years, it is okay. But after 3 years, it means after year 3, there's a growth rate. Then you have to change the formula. It is given here. You terminal value. TV mean terminal value. Equal cash flow 3. Year 3 cash flow multiplied by 1 plus G. 1 plus G means growth rate. This is a new formula for the calculation of terminal value with the growth. So now terminal value means the value for what is the value today of future cash flows over the infinite period. We don't know. We don't know unforeseeable future. Foreseeable future is a very short period. So that is the way we value. Now, if you have a business giving cash flow 150,000 forever, so we can calculate the value for that. That is the beauty of this formula. Whatever the value you receive, and you can assume the growth is 3%, it is very reasonable growth rate. So then you multiply it by this formula cash flow 3 is the 150,000 into 1 plus G mean 1 plus growth rate is 3%. It is given in the sum. So 150,000 into 1.03 divided by 0.07, because R minus G mean the denominator, R minus G. R mean discounting factor, minus G mean growth rate. So you will arrive at 0.07. So if you multiply 150,000 by 1.03 divided by 0.07, you will get 2.2 million year 3 value. This is the value you are getting in the year 3 if you are getting 150,000 forever. This value is year 3 value, because the formula says it is cash flow year 3. So then you have to bring that year 3 cash flow into present value today. So how do you calculate that? You just divided this total 2.2 million by 1.1 to the power 3. Then you will arrive at 1.6 million. So then we will say our business value is almost 2 million. So my price is 2 million. Any questions? If you don't understand, please talk to me now. I think this is simple mathematics, but even that you can ask any questions from the how to develop formula. This is not developed by me. This is developed by mathematician.
Excuse me, sir.
Sorry.
Excuse me, sir.
Oh yes.
150,000 into 1.03 is understood.
Yeah.
That is the business value for the year 3.
Yeah.
But division by that discount minus G did not understood.
Yeah. Okay, fine. Very good. Now, this is the formula you use to calculate terminal value for whatever the cash flows forever. That formula is given TV equals cash flow 3, year 3 into 1 plus G mean there's a growth rate. If there's a no growth, we can put the 0 and go ahead. Divided by R and G mean R mean discount rate, G mean the same rate, same G, growth rate. So just you put our discount rate here as R, it is 10%. 10% mean if you divided 10 by, you can so you can arrive at 0.10, no? 10% mean you just divided 10 by 100. So you will get 0.1.
1.03 divided by R minus G is a ratio, some kind of ratio.
Yeah.
Is there a definition for this ratio or something?
Yes, there's a definition. This growth rate is G, right? The 1 plus G mean growth rate. So you multiply that one mean 1 plus growth rate mean 10%. No? Now growth rate is 3%. So 1 plus 0.03 is 1.03.
Yes, that is understood.
Okay.
But the division portion is not understood.
Yeah, this the formula is given. No? You multiply this 1 plus G divided by R minus G. That is the formula.
Yes.
So in that formula, you have to substitute R for 10% and the G for 3%. Then
yes, substitution is understood, but I was thinking about the meaning of this formula. What is this formula?
Yeah, this is the formula given by the to calculate the terminal value of cash flows. This is formula. So that's why I asked you, I'm not going to teach you how do you develop this formula. Just use this formula for calculation of terminal value.
Okay, sir. Thank you.
Okay. Right. Did you get the amount? Did you get the amount correctly? Now why we are bringing this value? This is the value for whatever the cash flows after the year 3 forever. So you are
Yes,
now
sir,
you
this
are getting.
amount is correct. Yes, I got this.
Yeah. This is for the cash flows after year 3 to the infinite period. So then you have to bring this 3-year value to the year 0 also. That's why we are again dividing this one price over this amount by 1.1 into the power 3. Is that clear?
Yes, sir, that is clear.
Okay, thank you. Now your terminal value is 90,000. All you add together. This is the value of your business today in the year 0. Right. Anybody is having questions? Anybody else? Malinda is okay. I think he's also left. I think Sanjeev is there. Sanjeev, is it okay?
Okay, sir. Okay.
Mandula? So please, sorry. Right. Next one is the similar public company valued at 5 multiplied by EBITDA. Earning before interest and tax company. Even in the exam, I will give you the figure. I will never ask you to calculate what is EBITDA. Just you apply. No, this is very simple. Earning before interest and tax and depreciation and amortization. It is jargon. So what you should understand? This is the profit, earnings for your company. So similar public company is valued at five times the EBITDA. So then you use that one. You also can tell the similar company in the share market valued at 5 times the EBITDA value. We call earning before interest and tax and depreciation and amortization. This is the profit of the company. Simply say. So you are earning 400,000 per year, right? So just you can multiply it by 5 and ask them to pay 2 million. Now, if you wish to put 10, okay, it's up to you. You check whether the similar company has sold for 10 times of the EBITDA. So you can tell the buyer to pay you 10 times the profit. What you are getting today, the annual profit. Very simple calculation. So you have to check how many times they have used for the valuation. Similar company. So if your company is today you are having John Kills to sell others outside, you will come up with the value. You value your firm by multiplying by 10. So you will say, I need 10 times of the profit today. So if your company is smaller or riskier, I have put in red. So you can give a discount. So according to this, 5 times is 2 million. But my company, the public company which is sold at 5 times is a public company. My company is private company, very small company and riskier. You might apply a discount, say, okay, this is you are giving 20% discount, right? Just you multiply 20% into 2 million, it says 400,000. You will arrive at the same figure. This is, I think, very simple. So only thing you need to understand, you get the annual profit. It may be EBITDA, it may be PAT, profit after tax, profit before tax, PBT. These are the jargon used in the accounting field. Profit before tax mean PBT. Earlier we told CapEx, OpEx, something like that. I think for finance people, it is very easy. They will understand. But non-finance, they can understand. Only thing, this is the multiplication. You ask the company accountant, what is the revenue, what is the profit of this year? He will say, this is the profit. You can use any profit, after tax, before tax, whatever you want. But this is represented by this EBITDA mean earning before interest and tax and depreciation amortization mean before deducting all these expenses, this is the profit. But net profit may be less than this because there may be interest, tax, depreciation, amortization. These 4 things you have to deduct from the 400,000. But we don't deduct. For example, assume you have a pharmacy. You own a pharmacy and you earn 500,000 per month. But you are paying a pharmacist, like electricity bill, water bill, everything. But you say, yeah, I'm going to sell this pharmacy 10 times the annual revenue. So annual revenue is 500,000. So 10 times means 5 million. Give me 5 million. That is the way we value. So there's a formula for you to value cash flow forever. So it is very simple. So formula P divided by R. It means discounting factor. Present 400,000 divided by discounting factor. If it is this case, if you divide it by 400,000 by 0.10, it is 4 million. So that way also you can calculate. If the discounting rate is 20%, this is 2 million. So I will give you 3 formula. This is one formula I have told you. This is to find cash flow with growth. If it is no growth, just you remove the G on the top and the G from the denominator also. Then you will see cash flow here 350,000 into 1 mean, no meaning, divided by 0.0. Then tell me the answer for that. Without G, you remove 0.3. So then 150,000 into 150,000 into no G. G is 0, then multiplied by 1 mean again 150,000 divided by 0.10. What is the answer? Can anybody tell me the answer?
Sir, 0.10 minus 1 or just 0.10?
Yeah, now you can see this formula for cash flows with the growth. So now I am talking without growth. So if you want to find the cash flow, value of the cash flow forever, so you remove the G from this formula, right? Okay. So then you remove the plus G, 0.03 means then only 1 is remaining. Denominator, only 10%, 0.0, 0.10, 0.00 you cut. Good. No growth. So G you can remove from the formula and calculate the present value of 150,000 without growth. What is the value as at year 3?
$1.5 million or something?
Yes, correct. Now you have learned that formula also. If you have a cash flows without growth, now it is a assumption. Now it can't be 150,000 forever. If it is a pension without increasing, maybe, or agreement, according to agreement, you are getting 150,000 forever. It's okay. But it is very unlike that you will get 150,000 forever without growth. So, but here we assume the growth rate, which is very sensitive thing to apply because we know that our business is growing. So therefore, definitely the business will grow, the profit will grow. So if you want to calculate without growth, you just remove the G from the formula. Then it is very simple formula, cash flow 3 divided by R. You got my point? So if you want to value the cash flow without growth, it is a simple formula, cash flow year 3 divided by R. So it means 150,000 divided by 0.10, 0.10. You will get the answer 1.5 million. So again, that cash flow you have to divide it by 1.103 to find out the today value. So if you have a constant cash flow, it means don't change. Always 150,000 forever. Just you divide 150,000 by denominator is a R, only 10%. 10% means 0.10. So you will get 1.5 million. Is it clear to others? So we will check one by one. Ganga 516.
Yes, sir.
Okay. Right. Because I'm very concerned about you all, because this is something with mathematics and accountancy. So I don't want to, even that's why I have not, how do you create this formula? So just give the formula. If there's a growth, you apply this formula. If no growth, simple formula. Cash flow divided by growth, the rate, discounting rate. It means the cost of capital, whatever you say, discounting value, discounting rate is the. So if somebody is giving you 5,000 forever, your discounting rate is 10%. It means the interest rate at present today, simply. So you can find the value of your money. 5,000 forever. It is like something like payment of royalty. Okay. I'm going away. Right. Now this is I don't know, this bar is giving problem to me. Right. Asset-based approach. This is very simple. Now, if I ask you this type of a sum in the paper, you can easily score marks. But please understand. Now, asset-based approach, adjusted net assets method. So what we are going to find here, what is the net assets? Net assets mean assets value minus liabilities. That is the net assets. Now there are two values, book value and the fair market value. Fair value, we say fair value as well. The difference is, now if your company buy a vehicle today, assume 5 million. Even after 5 years, the book value will be 5 million. Because you are recording the cost at the time of purchase. So your book of accounts will say cost is 5 million. But if you go to the market, now vehicle price has gone up very, very high. So that is value more than 10 million. So therefore, the book value need to be changed, need to be checked with the fair market value. Simply, if you purchase a land, I purchased a land in 2003 at 125,000. So after 2003, after 22 years, the neighbor came and asked me, would you like to sell this land? I said, okay. What is the price? Then I calculated at 13%, it came around 5 million. because I assume that 170,000 invested in the bank for 23 years at a rate of, at that time it was 20%, but I put only 13%. Then he told me it is a little bit high. There was a land away from 100 meters to your land, and they sold 50,000 per perch. I told, okay, give me 2.5 million. So after that, we agreed to sum of rupees 2.5 million. There is the value for my asset. I compare the prices of the adjoining land, at what rate they sold. So that is this is something like that. So you have to see cash, definitely cash 50,000 is same thing, because it is both are same, book value and the fair market value. If you have 50,000 today in your books of accounts, if you go to market, you will get the 50,000. So equipment also same, 300,000, 400,000. So in the exam, if you have given both value, so you have to get the market value, fair value. So because why? Because prices has gone up. So inventory 100,000, inventory maybe why 80,000. In your company, inventory maybe your products. As you all know, if you want to sell if you are leaving this country, or so you want to sell your furniture, definitely they will come and say, give me at a 50% discount. This is worth 100,000, give me 50,000. Likewise, inventory may be lesser than the book value. So that's why 100,000 into, it has been 20% discount, 80,000. So building, again, building is 500,000, value is 600,000. For your calculation, you should get fair market value, because it is the real value, because otherwise you are losing. So if you go for the book value, what is the total? 500, 600, 950. 950 minus 700, 250 means 700,000. My God, you are going to lose 180,000. So you can tell, hi, this is the book value, this is the market value. So if you agree, I will sell this at 880,000. This is simple calculation. That's why I told you all to calculate your net assets. Net assets mean asset minus liability. So from your asset value, if you settle the loan, liabilities mean loan, overdraft, whatever the long-term loan, then you will arrive with the net asset. So in the exam, I might give both prices, and you to calculate the asset-based approach, just a net assessment. So you should know only what is the fair value market. This is not a very difficult sum. So business worth is 808,000. Right, I will go back to again, because I want to explain other mergers and acquisition. So here I have explained you income approach, market approach, and the asset-based approach. Now we'll move on to mergers, acquisition, divestment, and emerging trends. Anybody having issues with the valuation, please? If you don't understand anything, also tell me. It can't be. Can I get any response? It is difficult. Or... Is it difficult, this sum? So nobody is there. Right. Mr. Adhikari. New name. Mr. G. Loganathan.
Yes, sir, it's understood.
Okay, thank you very much.
Okay.
Right. Right. Now we'll move on to mergers, acquisition, divestment. Divestment means you are selling your part of your business to another company or another organization. So emerging trends. So now this is given in your syllabus. So definitely I will ask short note on mergers, acquisition, whatever. So then just you have to describe very briefly. Now, one of participants asked what is the merger and the joint venture. So then now we will clear all the jargons. So merger definition is merger is when two companies combine to form a new single entity. Now Maruti Suzuki get together and create Maruti Suzuki. So then no Maruti, no Suzuki. Maruti Suzuki. So one example. Hewlett Packard. Packard and Hewlett. So they both company get together, new company forms. Why we do that? So we call it synergy benefits. So then, so if I ask why mergers are taking place, so then you have to tell me actually this is because of synergy benefit. What is synergy? Synergies mean in mathematical terms, 2 plus 2 is not 4, 5. Because when you get together, your value is more than when you are in isolate. That is the explanation. Synergy benefit. So for example, even marriage, I told at the beginning, it's like something like marriage. So you are having good knowledge, good technical knowledge, and you marry with lady who is having huge capital. So then you can do the business very well. Why? You have the knowledge, she has the money. So something like that. Don't marry for money. So a merger is when two companies combine to form a new single entity. So merger means after the merger, a new company, new single entity. So now I think if you all can remember in the Sri Lankan context, the bank were asked to get together and form a company. Now why? What is the benefit? Now I told you synergies plus reduce cost. For example, small finance company is two finance companies are operating in Sri Lanka. So they both companies having iron oil branch network. So you are sharing the customs. Why don't you get together? Then you can reduce the cost by 50% and share the profit. That is one objective of the merger. Because merger, even central bank asks other small bank to come together and get together and build a company which is having a higher capital. Because if two companies can get together, then the share capital will be much more than the individual companies. So they get together. So they have a more strong market. Why? They can use their one network to because you are handling Ampara, you are having two branches, two companies having two branches, but same, you are serving to the same customer group. So that is the reason why we need mergers. So, and think about the marketing program. All over the country, we are doing marketing, they are also doing marketing to attract the customers. So from the two company heads can get together and talk. My dear, we all having branches island wide and serving only 500 customers. So why don't we get together and reduce 50% of the cost? A lot of merger happen in the world with a huge cut in the employment. So that may be again an ethical issue. We should not allow get together because people are losing their jobs. Really. Google also did the same thing. So why we need this merger? That's what I'm telling you. You should understand what is merger and why we are doing the merger. So that is the only thing you have to understand. So basically, you need to achieve synergies. 2 plus 2, 1, 2 plus 2, 5. It means 2 plus 2 is not 4, 5. There's when you get together, there's additional benefit. So reduce cost. I explained you both company having branch network island wide. So get together and doing the business using one chain or expand market share. So example, Disney and Pixar. Disney is, you all know. Pixar is I think animation company. So they got together. Disney merged with Pixar to strengthen its animation division, combining Disney's marketing power with Pixar's creativity. Now the creative companies there and the result, Disney animation business became a global leader again. So what are the goals? If I ask you why you need mergers, then you can tell. There's a synergy, cost saving, increased market reach, a shared technology or talent, and greater economies of scale. Actually, what is mean by economies of scale mean now when you are the separate entity, for example, A company and B company, A company saving customers 500, B company saving customers 500. So when you get together, you are serving 1,000 customers with 50% of the cost. Why? You have eliminated the duplication of assets, duplication of branches all over the country. So then economies scale mean you can serve more customers and the cost is 50% lesser than that, at least, just an example. So therefore, that's why mergers are happening in the world. So you can read more and more in the web, you can find. But for the exam, basic idea is enough. Right. Second one, acquisition. An acquisition happens, I told you, one company purchase another company. Not merger. After acquisition, acquirer is there, acquiree is not there. The company is vanished because you are buying that company and settling the assets and bringing their business to your group company. So then, example, Facebook and acquiring Instagram 2012 for 1 billion. Now, why they buy? Facebook brought Instagram to capture the growing mobile photo sharing market. Instagram continues to operate under Facebook Meta, but benefit from its infrastructure and reach. So because of Instagram, actually Instagram is only to share most of the time photos, pictures, videos, right? Goal, what are the goals? Rapid market expansion, gaining new technology, eliminating competition. Right. Divestment or divestiture. Divestiture. That also I told is selling the part of the business. So I explained you what is conglomerate diversification. So you see you have purchased different type of businesses and now you can't handle. So sometimes this company make loss to the whole group. So better to remove that from your businesses. Why? So making loss and eating into the other profit. Now in Sri Lanka, railway, CTB, transport board, making huge loss to the country. So earning of other people is used. I think railway is getting 3 billion, 5 billion from the treasury. And the Ceylon Transport Board also same. So that's why even in the government, they are selling businesses to other parties. So divestment means that. Because one thing, if you sell, you can raise more money and use that money to invest in other good companies, return where the return is very high. So this helps the companies to refocus. Because without understanding, you are keeping on buying the companies and bigging the conglomerate into bigger and bigger. But now you see people are, some companies are making losses. So, example, even in the exam, better to keep in mind this example because then you can really understand. So General Electric, you know, this is a USA company and selling is GE Capital Businesses. GE divested financial operation to refocus on industrial and energy business. Now, I think financial operation they were handling and now they are moving to the industrial and energy business. That is their core business. So EB spinning off PayPal 2050 allowed PayPal to grow faster independently. Goal, these are the example. Focus on core strength, raise fund or reduce debt, improve profitability. So divestment also need. So next one, emerging corporate strategies. So in addition to the mergers, acquisition, joint venture, now the joint venture. So two or more companies create a new entity to pursue a shared project. So I explained example Mattala Airport. So the company can create a joint venture, new entity, and do the project or market even. Sony and Ericsson form Sony Ericssons. to combine tech and mobile expertise. So these are the examples. Two or more companies, even not only two companies, three companies can get together and create the joint venture to do the project. Now, is it clear now, joint venture? I think one asked what is joint venture and the merger. So now I think very clear. Because even after this project, the three companies will be there working as independent companies after the project. But only for the shared project or market, they are doing this joint venture. So strategic alliances. This is where the companies get together without forming a new entity. So strategic alliance mean getting two or three companies or number of companies not important, but what they only the alliances, strategic alliances. Example, Starbucks and Barnes and Noble. Starbucks is famous for coffee shops. Now, coffee shop inside bookstores to increase foot traffic. Because then the people who comes to purchase books, they might have coffee. So similar synergy benefits. Right. Spin-offs. I don't know. Meaning word is not there. A parent company separate part of its business into new independent company. That happened. Here parent company means group company separates part of its business into a new independent company. Example, HP Hewlett-Packard splitting into HP Incorporation and Hewlett-Packard. So there are two companies. Hewlett-Packard Enterprises. So then they are doing their businesses independently. Earlier they were together. So even Selinco Group at the beginning, even though it was a failure conglomerate, but now even insurance field, they were doing business life and insurance separately, right? Or some companies were doing get together. Then now they have moving separately life and insurance. Life business is handled by the separate company. Even the law is the insurance Hello. Hello.
Yes, sir.
Sorry, I don't know. I was disconnected. Now, right, we were talking about strategic alliances, spin-off. Right. The leverage buyouts. Leverage buyouts, we call it LBO. So an investor, often a private company, buys a company mainly using borrowed money, repaying debt through the acquired firm's cash flow. Now here what they are doing, now I am a big company and having trouble to repay the debts. So what my plan? So I will get the borrowings and acquire the new company. So you don't use your own money. So buy a company mainly using borrowed money, repaying debt through the acquired firm's cash flow. So it means you use borrowed money. Borrowed means you have taken the loan or whatever. So example, KKR's buyout of RJR Nabisco. So it is a very old one case, but this is a good example. Now, another item is reverse mergers. It means a private company merges with public shell company to go public quickly. So, example, DraftKings 2020 went to public through a reverse merger with the special purpose acquisition company. It means, you know what is the difference between private company and the public company. Private company in Sri Lanka, now you can create a public company having one shareholder. Earlier it was 2, maximum 50. Now, but public company mean the minimum 7, but unlimited, maximum. So usually private company is a very small company and a public company is a big company. So reverse merger happened when private company merges the public shell company or public company. This is called reverse merger. Now, these are the strategies we can do to grow your business. So I have given what is merger, what is joint venture, an example and the main goal. So yes, you can go through to understand each and every concept, right? What is merger? It is simply say two firms combine. Example, Disney, Pixar. Or synergy benefit. Now you all know what is synergy. So second one, acquisition. So one firms buy another. So buying company is remaining. But we call it acquire, acquiree. Acquiree is not there. After the acquisition, one company. For example, here it is Facebook and Instagram. Now this is one company. Why they Now they can't move into this Instagram business. What they did actually buy back that company. So they can increase their market expansion. So divestment or divestiture, the sell part of the business. So one thing it is to refocus the business, because two different business maybe get together. So then you have to remove one company, and it may help you to raise funds. So you sell one company and get the money. So then, I mean, you can concentrate your core business. So if your core business is Facebook or whatever, eBay, so then other business is not core business to you. So then we can remove. We can sell the part of that business and get the and increase your fund. It is a fundraising activity. Right. Next one, joint venture, shared new businesses. So shared resources. Actually, joint venture is most of the time it is created to complete big projects, because where you need different capacities. If you take wastewater project in Colombo, so we don't have such expertise. So what the Sri Lankan company can get together with the China corporation or any other foreign company, and one company in Singapore, one company in China, and get together. They form a joint venture in order to complete this very complicated project. So I was in the Ministry of Provincial Council and local government for 2 years as a financial analyst. So then I have come across that type of a huge project, maybe 15 billion project. So wastewater system in Colombo, it is almost 100 and 150 years old, and we need to connect all the wastewater line into one line and pump into the sea. So that type of big project, we don't have such expertise. So what the local companies they did, they get together and form a joint venture. It is allowed in our country, so you all can join together and form a business, and in order to complete this project. So this is something like sharing resources or sharing expertise, and again sharing profit. So because individually they can't take over this huge responsibility. So they don't have know-how, they don't have equipment. So this is again, you can get the synergy benefits. So strategic alliance, cooperation without ownership. So this is the example, mutual benefit. But now even food cities, I think some of the fuel station, they have a shopping complex of retail business. For example, I think gas company having small boutiques in the petrol sheds in Sri Lanka. So that sharing their resources and for the mutual benefits. At the LAF gas, they are having. outlets in their stations. The last one before the last, spin-off. Create independent company. Again, strategy focus. Last one, buyout using debt. So so you can read more and more examples and understand each and every concept. So even though it's more towards the accounting, or it is something like growing strategy. Okay. Any questions? So session is now I have completed. Any question with regard to valuation sums or whatever I explained so far? Silence me, no problem. Any questions with regard to these calculations?
No, sir.
Sorry?
No, sir, no.
No. Right. So again, I have to go by one by one. I think Mr. Vijita Raipriya, the new person, new participant.
Not new. I was there from the beginning, sir.
Right. But your name may be different. You are using different equipment, maybe.
Yes.
Sometime mobile phone. So I'm looking on the numbers. Any questions?
No, sir, no. Thank you, sir.
No. You can do this sum also without any issue.
Yes.
Calculation of cash flows.
Of course, this is a heavy dose with new terminology, new thing, but interesting, sir.
Yeah. But don't worry that I am not going to check the technical thing. As I told you at the beginning. So these are, I don't think that this is a very technical sum. This is only just applying the small concept called net present value. So please, this is advice to all of you. So if you are not a finance guy or accountant, so please go through the net present value calculation. That's all only I am asking. Nothing else. So these are the very important areas, because after all, you should have ability to understand what it is, and because it is used all over the world for financial decision. So expansion, for example, even the expansion of the project, expansion of the product. As an accountant, you have to see what is the cash flow for 5 years, because you are going to invest. So then they will ask what is the cash flow. So then the accountant finance manager can work out. But at least as a marketing person or any other operational manager, you should have ability to understand what they have put into the paper. That's all. You don't want to be a accountant to understand this concept. This non-finance person can understand if they want to clearly identify the way of calculation, the formula used. This is a small formula. I have used only 3 formulas. 1 divided by discount rate 1, and there's another formula to calculate the future cash flows terminal value. That's all. This is the little bit difficult formula. This is to calculate future cash flows with the growth. If no growth, you just remove the G. Then it is only cash flow 3 divided by R. So income approach is not issue. Market approach only I explain. You have to take the profit for a year and multiply it by 5 times, 6 times, 7 times, whatever the times. It is up to you to decide based on previous valuation and close valuation. So whatever method you can apply. I told you the company EBITDA mean earning before interest and tax and depreciation and amortization. So again, there are a lot of variation to this. Some company can use earning profit after tax, which is called PAT. Sometimes profit before tax. So it is up to you to decide. So you are the seller. So you can tell, yes, my company, I am selling 5 times of the profit after tax. So there is no hard and fast rule to say you have to multiply by 5 times. It depends. It depends. It depends on the market where you are in and the earning power. So if it is the company having a monopoly, definitely they can value more than the other companies, because you are the pioneer in that particular industry. So you can claim higher value. So like celebrities, they charge, big people charge big amount. So I think what I am asking, I will put a question from this calculation, because this is accounting paper. Definitely there should be a calculation sums, but don't worry that I will discuss the way at the last session. So therefore, those who are not familiar with these formulas or calculations, please go through and again and try to understand simple formula and apply. So in the exam, I will give you whatever the discount rate. Don't worry about that. We are not, as I told you, I'm not going to ask you how to create this formula, because that will difficult some of your life. So not all. So go through whatever you want. So any question last but not least? If no questions, we can wind up.
Thank you, sir.
Thank you very much for listening and answering my questions, Ganga. Thank you.
Okay, sir. Thank you.
Thank you, sir. Good night.
Thank you, sir.
Okay, thank you.
Thank you, sir.
Thank you.